All right. So what do you have in mind today? What do you want to talk about? Anything specific from the last week? I do want to talk about something I read around opportunities in East. So yeah, do want to talk about that. And earnings are back, so we want to review some of the earnings as usual. Do that very often. And anything else what you may have in mind? So let's get started. I see some new names joining in. Yeah, if you have anything specific that you're interested in talking about, or generally discussing or learning, do let us know. I generally would want to keep an open forum, but I want to make sure that these 2 hours are well utilized. So I do spend a lot of time in preparing the content for these 2 hours. But if you have something else that you want to talk about in a specific topic, feel free to pitch in and and suggest something. So that's how it goes here. Okay. All right. Oh, I see Henry. Henry, something off with your, either there are 3 Henrys, but I see 3, maybe you're joining from different devices or whatnot. I see 3 Henrys out here. All right. Yeah, we're 3 minutes over. So let's start with something that we talked about last week. I gave you option of 2 books that I had bought, and you suggested to read this one, How to Invest by David Rubenstein. So here's some of the things that I noted from the chapter 1. It's a great book. I mean, I really like this. Basically, this book has interviews of great investors and of, I would say, investors in different asset classes. So here's from chapter 1 is about interview from Larry Fink. Larry Fink, if you recall, he's a CEO, or the most powerful, I would say he's the most powerful the person in the financial world, because he owns and runs BlackRock, which is the biggest asset manager in the world. BlackRock has got close to, I guess, maybe $10 trillion in asset under management. What's the latest number? BlackRock asset under management. 2022, it was almost 9 trillion. So, oh, okay. So they say in 5 years, it will probably top 15 trillion. So Larry Fink is a very powerful person. But I was a little intrigued to see what he mentioned about Wall Street, which is Wall Street is not about investing. This is coming from the biggest asset manager on the Wall Street. Says Wall Street is not about investing. It's all about velocity of money, right? And this is one of the corrupting things about the Wall Street. That because it's not about long term, it's just about facilitating the trade, right? That's what we see a lot of brokers, etc., doing the same stuff. Is, hey, let's facilitate a trade, make sure it's easier for customers to trade, whether it's profitable for customer or not. Who cares? Wall Street doesn't care, right? And I would say this was very honest confession coming from Larry Fink. Is it's not about investing. It's not about long term. It's just about velocity of money. That is why I'm very skeptical, and watching any financial channel or listening to any analyst. We have to do our own homework, because it's not about you making money. It's about Wall Street firms making money. Other interesting thing I saw was a lot of focus on risk management, and they have a system called Aladdin. The other third one was the dominant conversation in financial media is about the markets, the TikTok of what's going on, right? Every second, every minute, what's happening in the market, which stock is going up, which stock is going down. And suddenly if you see the analyst or the panel that they bring in is based on what's interested or what's more, what are a lot of folks interested to see, not really what is the right thing to bring in. Right? So we lost the narrative of what's important to all men and women who are trying to build to live and retirement in dignity. Right? Last one is most common mistake made by investors is that they get accustomed to an economic environment and assume that that environment will last forever. I think this is, we're going through this similar kind of it's an environment right now. Is the increase in inflation has taken everyone by surprise. A decade of ZIRP environment made each one of us, I would say, pretty, what word can I use? Where we are not careful, we became pretty careless, saying that zero interest rate will stay forever. And what's been happening over last 18 months or so has really opened the eyes. We become accustomed to a particular kind of environment, and then if we think that's going to last forever and we build our portfolio based on that, then market gives us surprises. Finally, he also talked about a new product which is called LifePath Paycheck. We'll see what that comes out to be, but that's from chapter 1, interview with Larry Fink. Right? Little bit of it's a different kind of a book. It's basically excerpts of interviews from the masters of the craft, and I hope to learn something from those masters, and I hope to bring it for you, some tidbits so that you also can maybe find some pieces of information that's useful in your own investing journey, right? So so next week maybe I'll bring something from the next chapter. Cool. All right. Talking about a macro. I'm not going to get into the usual macro stuff, looking at jobs number, etc. But I read through a blog and that was very interesting. So I thought maybe I'll share here that some notes from the blog over here, which is, let's play a game of good news and bad news. Right? So good news is inflation is falling at a fast clip. We have seen these numbers. The latest inflation number that came in was just had below 3%, 2.97%. But the bad news is it's still higher than the wage growth. So the real, I think for wage earners, the problem is still the same. Even though inflation is coming down, it's still higher than how your wage has been increasing. Good news is stock market has recovered all of the bear market losses. The markets are up, what? Let's look at by 17, 18%. Let's do year to date, 18.74%. Right? Almost 19%. So in this year, and it has recovered all, I think, the bear market losses, which was the lowest point was here somewhere in October, where we hit almost 350 to now 456. So this is close to what, 33% upside since the lowest of October, which is a great run. But the bad news is there will be a few more bear markets in future, especially for now, at least as we've been talking over past few weeks, I'm still not convinced that we ought to be at 456. But who am I? I mean, a lot of it's impossible to predict the markets. So I don't want to take a position saying, no, I am right, market should go down. We never know how long this could continue, but 19% in, I would say, first half, close to first half of a year is a pretty good return. Will this continue in Q3 and Q4? We don't know. And I don't think anyone would know, but I'm being a little cautious. Especially QQQ is what up now 42%. Probably in last 3 days, we had some red candles on QQQ, probably would have brought something down, but even after that, it is up 42%, which is crazy. I hope with this rebalancing is happening on, was it Monday or Tuesday? Does anyone recall? We talked about rebalancing, NASDAQ rebalancing. Was it 24th or was it 23rd? But in any case, I think it's probably gonna happen after market effect 724. Thanks, Fred. Yeah, so rebalancing will happen. Maybe let's see if that brings it's into a little more saner zone. For now, like 42%. That's amazing. But there's going to be more bear markets in future, right? Good news. Conservative investors finally are able to get some decent yields on savings. If you look at the US Treasuries, I mean, I do ladder on 17-week. The latest one that I got last week, not last week, it was this week, 18th of July, was 5.42%, right? 5.42% annualized yield on a 17-week treasury. Pretty decent. So it's after a long time, those who are conservative investors, I'm not saying that I am, but I would like to hold, given the environment right now we are in, I would like to hold a lot of cash on the side. And right now, treasuries are paying decently good to hold cash on the side, right? So why not? And 5.42% just to hold and sit on the cash, I've never seen those earlier. So yeah, so now you can find some decent yields on savings. Even if you find that the hassle of investing in treasuries is too much, some of the banks are also paying 4% on their savings account. And I think some of the neobanks, they probably are paying close to 5%, right? If not 5. But bad news is inflation has eaten into these higher nominal yields, right? Good news is nothing is broken in the economy yet. And that was also one of the themes why we saw markets being little resilient this week is many of the firms or economists, they are bringing down their forecast around how bad the economy could be or how deep in recession the economy could be, right? Many of the Wall Street firms have now moved into doing maybe a little bit of soft lending, not really hard lending. And some of the Wall Street firms are in fact reducing their probability of US economy falling into recession. Well, bad news is there is a lower margin for error right now. Good news is we have the lowest unemployment rate in America since 1969. Bad news is that these gray bars on the chart that connotate recession, they actually follow the lowest rate of unemployment. So these good and bad news all come together. Few more. Good news is now we have dozens of different streaming platforms with thousands of TV shows and all that. Bad news is we might not have any new ones coming out anytime soon because we have a writer's strike. And also now we have actors strike. Right. Good news is gas prices are down almost 30%. But the bad news is the price of car to put the gas in has gone much higher. And last week, I was at the dealer shop because my wife, she had to drop a car for the regular, I think 90K service and all that stuff. So I just went in the showroom just to look at the car, and looking at the sticker price gave me a sticker shock, because even now also there's a dealer markup of $10,000 on, which was the one? I think I was looking at Toyota RAV4. There's a $10,000 dealer markup. No more dealer discounts. It's a dealer markup. So even though the gas price has come down, the price of the car is still higher. I know if there are some Tesla fans here, they'll probably point me to Tesla. Tesla has been reducing the prices, and you don't need gas for it. Good news is housing prices never crashed. Bad news is housing still remain unaffordable for a lot of buyers with 7% mortgage. There are a few more of these good and bad news. I thought I'll start with this as a warm-up exercise, before we get into more serious stuff. Like to get warmed up, get my vocal cords working fine. And so thought I'll share some of these with you. If you want to go through the whole list, it's on the blog of a wealthofcommonsense.com. All right. Any other good news, bad news that you've heard? These are the yin and yangs of life, or I would say two sides of a coin. So that brings me to the next chart, which I found interesting. Is we've been talking about recession. So which business cycle is US in? And right now, and this is what I found from a Fidelity investment research, is right now, overall in the world economy, the cycle seems to have been different. China is way over here where they are still, China still hasn't recovered. I mean, the recovery, post-COVID recovery, we haven't yet seen in China. Earlier, there were hopes of when China started to open up that we would see the recovery. But right now, the numbers that are coming out from China are really not positive, right? The growth has been slowing down, and there's been real concerns about China economy. So it's still haven't recovered. Whereas some of the other countries, US, Australia, Canada, Korea, Brazil, we are kind of entering into late stage of expansion. So we have seen that expansion over past few quarters. Now we're getting into late stage after COVID, and maybe getting into contraction based on all the interest rate hikes, etc., that we have seen. So overall, the world market is a little bit divergent in terms of different business cycles, with the largest economy right over here in expansion or late stage expansion, I would say. And the second largest is still have to start to move into the recovery post-COVID. Right? The other in chart, and again, this is not a recommendation, you can do whatever you want to do, is around what kind of sectors works best in different business cycles, right? Early recovery cycle, mid, late, or recession. This shouldn't be a surprise to us. Of course, in a recession, the things that we cannot live without will work best. Those are considered as a safer sector. Money rotate from a high risk sector to the safer ones, which are basically consumer staples. We gotta eat food. We gotta go to the grocery market. Gotta wear clothes. Healthcare, right? You may postpone some of the elective procedures, but still gotta eat the medicine. I still got to go and do the regular checkups and all that stuff. Utilities, you got to pay the bill. We need the lights, we need the water, we need the gas. So recession, while you'll pull back on your discretionary spending, will still continue to spend on staples, healthcare, and utility. And these are the sectors that generally perform well during recession. Or let me put it the other way, they don't fall as much as, let's say, the infotech or the growth sectors will fall in. Right? Something interesting to keep an eye on if you are looking to manage your portfolio, depending on if you are a macro guy or gals. But I found this really interesting or fascinating. What else? Sector-wise performance for this month, pretty no change, I guess. Information technology is consumer discretionary, S&P 500. I think this month, every sector is in green except communication. A year to date, looking at is 44% on the tech side. We saw QQQ, S&P is almost 19%. Consumer communication services, 35%. Two sectors that haven't yet performed this year is utilities. Utilities is boring when everyone is running towards those growth sectors. It's but obvious that utilities won't perform that much, right? And of course, energy. And I think this is a regular cycle. We saw 2022, the worst performers were information tech, communication services. We saw S&P was down, what, 18%, 20% in 2022. Energy was the winner in 2022, up, I don't know what, 40% for the year or something like that. And now the tables are turned, and obviously energy have yet to catch up on, with the rest. And some economists, they say maybe Q4 is when energy might come back up if you are really energy person. Yesterday during my evening walk, I was listening to Macro Voices podcast, and let me just bring that up so that if you're interested on energy side. So they brought in an expert, Dr. Anas Alhaji. He's one of a renowned expert on energy and outlook. I would say it's a good listen if you're interested in energy markets and what's happening in energy and the outlook of energy. Not that I'm a big macro guy or I have any expertise in energy, but I was looking for something to listen to while I was going for my evening walk, post dinner walk, and couldn't find anything else interesting but macro voices. So I thought it's always good to catch up with a new area that you're not familiar with, just to understand more. The knowledge never goes waste. So, and yeah, I found something interesting from that podcast. So that's here on how each of the sectors have done. Index wise, I think Dow Jones has had some of the best performance, the weekly performance after many years. Others we've already discussed. Fear and greed index, right? Still logged into the greed zone. And if you look at over maybe almost a year, go back over a year, every time it has moved kind of into the greed zone, we do see market pulling back. But this time, at least, it has stayed in this zone for, I would say, quite a long period of time, right? When it entered the 75 year and has been in this zone, which is above 75 for almost, I would say, 6 weeks now. Right? Didn't see that happening here. Didn't see that happening here. So what I also did was to juxtapose the fear and greed index timeline with the S&P 500 graph, right? So just to give an idea of, this is where it moved into extreme greed. To me, it looks like pretty much in tandem, right? Not 100% replicating what's the fear and greed index, but almost the same. So this is an area where we have to see how long can this continue. Maybe the last 2 days of this week, does it tells us anything? Who knows? I mean, it's just 2 days. Given the fact that we now have earnings coming up, and now I think the expectations are already set in when it comes to earnings. Stocks have moved, especially the tech stocks have already moved a lot, 40% this year, the top 7. A lot of that growth or earnings growth has been priced in. The earnings haven't yet moved. So we have to see how these companies come up with their earnings. That will determine what happens to those companies. What happens to the stocks after earnings. Especially this week, I think the 2 biggies that came out, market didn't like. I mean, the results were not that bad. Both Tesla and Netflix fell on hard after the earnings report. And see, next week, I think we got a lot more earnings coming up. I saw another one, craziness continues in the market, is AMC was up 63% after earnings. Anyone out here tracks AMC? Only thing I saw was that the judge has denied the merger of APE, a ticker, and AMC ticker. I don't know how exactly it impacts this, but if the writers are on strike, if the actors are on strike, and we don't see a lot more movies coming on, what's the future of AMC? This probably might be going into bankruptcy. But it was crazy to see this stock up 70% on that news of APE and the judges denying APE and AMC merger. I see a comment, what will stop streaming companies in Netflix? Netflix will start shooting shows in foreign countries because of strike. I think they may shoot in foreign countries, but the question is, probably Netflix may be okay, but more the question is around the mainstream movie business, right? What happens to those mainstream movies? And my thought is, if they stay on a strike for longer, it's not going to be good in long term for actors and writers, right? Companies, studio companies will find out a way to get around this. And when I say we get around this, probably using AI or whatnot. And that won't be good for future, right? For writers or for the actors. So you can push it to some extent, but don't push so hard that they start to look for alternatives. Right? And if this strike continues for long, I worry that the studios will anyway start to look at alternatives. Right? Netflix, let's say the streaming companies will go out, hire outside talent and start to build it. And once that happens, then you are even a bigger trouble. So what's coming next week? What are you watching next week? A lot of stuff looks like next week gonna be a lot tech heavy. I don't see Amazon and Apple for the next week, but I do see Microsoft. So let's take note of what I'm interested in. There is nothing on Monday, Tuesday. I do want to watch what's happening to GM, especially after Tesla reducing the prices. what's happening to their margins. Margins is a story right now. We got a Microsoft coming in, Alphabet, Snap. Haven't seen Snap talking about AI. So maybe they need to start talking or drop some AI names to push up their shares, right? Oops, AT&T. Anyone following or holding AT&T? I know AT&T right now is in pretty bad shape. Let me take my words back. The stock is in pretty bad shape because of all the controversy around the lead in the cables. The stock is back to where it was, 30 years ago? I mean, and T is the ticker, right? AT&T. It was down to $13. Let's go back and see where it was. I can't even see $13 where it was last time. Going back to 2013, probably not. Right. So you may have to go back all the way 30 years to see when they were close to $13. Yeah, somewhere, maybe here. Okay, I know that's changing too fast for me. Yeah, so it's almost given up 30 years of gains. And if you're just buy and hold investor, that is the position to be in. I know AT&T pays good dividend. So, but how much is the dividend? So these are dividend yield traps sometimes where you look at. Now the yield is now 7.52. And if you're a dividend investor, and if you're screening for the high dividend yield, this I would say is a dividend trap, because we don't know how long can they even continue this dividend. This dividend yield is artificially inflated because the stock price has gone so down, right? And now there may be concerns around continuation of this dividend yield. So that's where I have some examples of, I saw another one, which is people are screaming at, is Disney. I think Disney lost, 5 years worth of gains. They're back to where they were 5 years ago. But that's where I say, as an option, traders, I hate to use the word traders, you guys know it, right? But option investor doesn't even sound well. So I have to use the word trader. But anyway, so for the ones who know about options and deal in options, we just got to reduce our cost basis, right? So I started, I think a lot of people say buy and hold. I would say buy and hold, but reduce your cost basis, because the things like what's happening with AT&T, it's not just one example, right? This could happen with any other stock also. Disney, same position. Disney is back to where it was maybe 5 years ago. So if you just bought and held it and didn't reduce your cost basis, it's tough. It's tough to hold on when the stock has given up all the gains. So I'll share a couple of examples of how using options have helped me to hold on to these stocks. I don't own AT&T, but I do hold Disney in my portfolio. So what else from an earning perspective? Burrito is coming. We got a Chipotle, Boeing. What else am I interested in? Let's see, Ford, GM, Ford go together. See, Intel. I guess that's it. Anything else you're interested in? Fred say Verizon, AT&T, and others took a big hit because of the copper line, but some recovered. Yeah, I do hold Verizon in my portfolio, but very small position, so I'm not bothered about it. But yeah, AT&T or not. Meta. How come I miss Meta? Is Meta in here for next week? Kunal, where is Meta? Hold on. Is Meta reporting next week? Oh, yeah, it is. Oh, it's right there on the top. How can I miss Meta? Yes. Yep. So, so these are the ones which I'll be watching, and probably we'll discuss some of these in our next session. Meta had definitely Meta had such a great run so far. It's up over 136% for the year, right? I had to sell off a little bit of a Meta this week. No, was it this week or last week? We'll go through it in terms of what's the buys and the sells for me this week. T for trouble, dumped 2 years ago, dividend is at risk now. Exactly. And sometimes these highly these too good to be true dividend yield, in fact, might too good to be true. So we always have to peel the layer to see behind, okay, the dividend yield has increased, but has the free cash flow increased? How are they paying this dividend? Have they increased the dividend, or is just because the stock price has gone down? So that's where digging into, I would say, one layer down helps us to know whether is it truly, the stock is good and hence the dividend is good, or the business is being impacted and the yield is just showing up because of the bad stock price. Right. So Adobe took off just after I gave you update on the new backend applications that forces people to buy a monthly subscriptions. Yes, you did talk about it. Thanks, Fred. And yep, Adobe reported earnings out here. And yeah, but I think, so when I look at Adobe is one name that shows up in a very strong company with a very strong balance sheet. I don't know. I haven't been able to pull a plug on Adobe yet. I never owned it. And I still don't have it on my portfolio. Oh, sorry, ServiceNow. ServiceNow is now. Right. Again, ServiceNow, what we looked at about 200, 250. That time I had some positions in it. I guess I sold it 400 or something. Because I had very small position, I didn't build that much of conviction yet. And now what is that? What, 600, close to $600 bucks? I haven't looked at ServiceNow for some time. And again, I think I've been careful in terms of what the stocks that I'm picking in, especially on the tech side. A lot of these tech names have run up so soon this year that I don't have a big conviction to add a new one until I see, the valuation really being a little compelling on this. So let's pick up ServiceNow and see. $50 forward PE of 50. Right? That's like super duper expensive for me. Yeah. That's like your yield is like 2% yield. Right. I am, again, it's not an advice, but with a 2% earnings yield, I don't want to put new money on ServiceNow. So it's like $117 billion market cap on $400 million of income. Okay. A current PE is 290. It's like 300. So for me, it's pretty expensive right now. Adobe, is 29. Right. So I see a question, how is 50 PE equal to 2% yield? You just, inverse it. So your earnings, so basically you're paying, when you say paying 50 means the price that you're paying is 50 times the earnings that you're getting, right? So the earnings from the stock, say if it's $1 and you're paying from a price perspective, you're paying $50 for it. So basically it's 1 by 50, which is like, it's yeah, that makes it what, 2%. So for me, it's super expensive right now, especially when you can make 5% in treasuries. So there is no premium, I mean, to take this much amount of risk on equity. It could continue to go higher, right? Don't get me wrong. But you have to decide as an investor in terms of what's your comfort level on investing on the valuation, right? Eventually, valuations will matter. Probably doesn't matter in the short term. In the long term, it would. So even though ServiceNow is a great company, I don't know in terms of how much have they been increasing their sales year over year. So let's look at ServiceNow. So with the revenue growth of year over year, it's 30%, right? It's not 50, 60. It's not bad, but it's not, blowing through the roof. So for that, paying 50, I mean, this is the, let's say trailing 12 months. Still same, right? 20 to 30%. So I'm not comfortable paying 50 PE for forward looking. In the current PE was almost 300. So super expensive for me. So yeah, maybe if in the earnings, the ServiceNow blow the revenue and the numbers out of the door, that may be time to look at, but not right now. I'll wait for the stock to prove its worth. LRCX, Lam Research, NXP, Dexcom, VLO probably is Valero. Cool. Okay, nothing on the crypto side. I didn't say anything specific, anything newsworthy to spend time. Maybe we could quickly look at not much change. I think last week for a brief period of time, Bitcoin went above 31K and Ethereum was above 2K, but now came back down to the usual band, right? So it's been trading between, I would say, 27K to 30K over last 4, 5, 6 weeks. A pretty tight range bound. So unless there is a really a new news or any, probably the first one gonna come out maybe in August, some news around Bitcoin ETF. Until then, I guess it's gonna stay in range bound. Yeah. So what buys and sells for this week? No, not SCHD. That was last week. So I bought ASML. After ASML fell down after earnings, so I picked a little bit of ASML. And a lot of sells in my portfolio for this week. Not that I am bearish about, let me just see, XLI. Again, all of these, because either I had a covered call or I had a call spread. So if there were a covered call, I let the covered call be assigned. Like Pinterest, I had a covered call at 16. So let it be assigned. I'm like, dude, Pinterest have had such a huge run up. Or not Pinterest, it's called Palantir. it had what is up 157% for the year, have such a huge run up, and it's got assigned at 16. That's fine. I also sold a short put at 16. If it comes back, I'll add it back to my portfolio. And I think all of these are, Pinterest, as was Palantir. Pinterest, I think I covered call is at 27, got assigned, and I'm okay with it. So is there anything which I'm better, except XLI, which is, I think this was a ETF, industrial ETF. I kind of, this is again hit its new all-time high. And this was a position I took in earlier. I don't recall when it was, but I just wanted to reduce one ticker so that I can add another ticker onto my portfolio, right? And right now, most of I'm picking up a lot more on the dividend side. So reduce the industrial holding and moved into the dividend ACHD. So that's the only reason. All others are because of the covered calls, etc. I'm still bullish about and will be holding all these in my portfolio. How about Eaton and PG stock? Sorry, haven't looked at Eaton or PG. Haven't analyzed any of these. But if you want, we can see, are they currently overpriced or not? We can run a reverse DCF if that's what you're interested in. Should we do that? Or maybe we can come back to that later.
It's okay, later.
Okay, Eaton is a power for EV. What is Eaton? What do they do? Power management company. School. Let me just see. Eaton. Okay, revenue growth. Numbers that don't look that attractive though. Okay, let me go back to the annual side. It's a industrial power. So yeah, growing at a sub 10% rate. EPS is decent, growing their EPS nicely. They have a good free cash flow, operating margin, gross margin 33%, operating margin 14%. Again, this is an area where I don't have much expertise around, industrial powerhouse. So if I compare it with, today, if I just look at this, just 30% gross margin seems to be less, because I am used to seeing 40%, 50%, 60% gross margins on the tech side of the, on tech companies, right? But I don't know if this is maybe a decent margin as compared to its industry. So yeah, can't help much on this one right now. Okay, the next thing I want to quickly chat about is around the leverage instruments. As the markets are going higher, or I think as the expectations that market may swoon into one direction or another are becoming bigger and bigger, a lot more investors are getting interested towards the leverage instruments. And I know even in these sessions, you have asked me multiple times, do you do 1x leverage, not 1x, what 2x leverage, 3x leverage, right? So I want to go back something that we talked about maybe 2 years ago, and spend some time on leverage instruments. How do they work? When and how one should use leverage instruments, and when you should stay away from these instruments, right? And let's see how the number shows up. So what are leverage instruments? So these enable us to have a, as the name suggests, leveraged play on the market. Right? So if you hold a stock, SPY goes up $1, your portfolio goes up $1, right? Or if you hold 100 shares, your portfolio goes up by $100. These leverage instruments allow us to amplify the gains and losses, if that happen, with by 1.5x. I've seen leverage products by 1.5x twice, 3 times. Means if you bought a long S&P leverage instrument and S&P goes up by $1, your overall portfolio goes up 3x, like 3 times of that. If S&P goes up by $5, your overall portfolio will go up by $15, right? If it is leveraged 3x. So you would, in the markets, this is what the Wall Street is. It will create a product for whatever you want to do, as long as Wall Street can make money on it. So we have a leveraged long products as well as short products. Say if we are thinking, oh, the markets are, I'm thinking that the market in terms of the tech market is too high too soon, right? And I'm a little bearish on the tech market right now. So if you're bearish, there are a few ways you can express your bearish sentiment. One of them is to maybe take a short position. Or if you want to play big or more, higher on that, a lot of people take short leverage positions, right? But the short also called inverse or inverse leverage ETFs. So there are both long as well as short. There are instruments based on index. There are instruments based on specific sectors. These are also known as geared ETFs. So there are 2 big players who provides these instruments. One is Proshares. So Proshares, for example, TQQQ. Right? So TQQQ is 3 times QQQ. So QQQ, as you guys know, it's a NASDAQ 100 ETF. Now TQQQ allows you to get exposure as 3 times exposure to the movement, which is 3 times the movement in QQQ, right? So if you are bullish on QQQ and you think, oh my God, maybe markets will continue to go higher, right? And if you strongly feel about it, my question is, should you go and take position in TQQ? Some, they do, right? But is that the right way is what probably we want to talk about. Other one is direction. So they also have a lot of these leveraged instruments, right? They got a bear, bull and bear, 2x, 3x, bunch of these leveraged instruments. Now, what's the utility? In my opinion, these instruments exist in the market because people use it, and Wall Street can make money out of it. In my opinion, if you really, really want to use it, you should use it only for a very short term, right? If you think QQQ is going to go higher, don't think that QQQ will be higher month down the line, or QQQ will go higher 2 months down the line. But if you think that QQQ is going to go higher tomorrow, that's a short term. I'm saying maybe you can look at taking a position on it. You shouldn't inventory it. Inventory means shouldn't buy and hold these leverage instruments. Right? And we'll see an example of why we shouldn't do it. Tactical maneuver, right? These are the instruments that are used to be as a very tactical step in managing the risk on your portfolio. That's why most of the time I would say, as a retail investor, we would just do fine by not even using these instruments. We'll be okay. Professionals may use it for hedging their overnight risk, that's fine. But as a retail investor, we'll be all just fine, even while staying away from these. But I do see a lot of retail investors getting greedy into it, because, gosh, I can make 3x, or I can double my money. Instead of buying QQQ, if I buy whatever TQQQ or equivalent or 2x of it, or QLD, I can double my money. But remember the fact that if you're inventorying it, if you're buying and holding these instruments, eventually the stock may go in your direction and you still lose money. Okay. If you are not awake by this, I'll repeat this. The stock may go in your direction. If you're bullish on QQQ may still increase over the month period, and you may still lose money. Longer the time period, more will be the risk. So as a retail investor, if you are professionals, their job is to manage the risk on daily basis. For they using these instruments, fine. As a retail investor, if you are getting interested in these, make sure you pick up the right, you use it in the right way. Okay. So let's do one simulation again. I think we've done that 2 years ago. A lot of folks might have forgotten, or there are new people in here. All right. So where we picked up a random number of any stock, right? And what I did here was just, let me just refresh, pick up some random numbers in which it would move the stock 10% up or down. Come on, it ended up 50% up or down days. I just want to see if I can, the randomness generates the data in which is more than, or the up or down days are different than 50%. Let's see. Okay, up days, 60% up days, and down, you are 40% down days out of these 30 days, right? And still, let's look at the performance. If you have no leverage, right, versus if you are 2x leveraged, if you're 2x leverage, $100 get reduced to what, $75. Even though in this month you had 60% up days and down days were only 40%, you still could end up losing money. And the reason is, it depends on if some of your initial days, if you lost money, it's very, very hard to recover. These instruments are rebalanced, or these instruments track daily movements, right? So it's for a longer, so when they track the daily movements, longer the duration, lot more is the risk. So you could run a so random or simulation on multiple different durations. Let's say this one shows up random 60 days. I just randomly ran that the stock could change plus 10%, minus 10% on any given day for 60 days. And randomly now it says that it has changed. It's been up 43% of the time, down 57% of the time. So if it is down 57% of the time, the negative should do better, right? So let's see where is negative 1.5x leveraged. It is still ended up worse than if you just didn't use the leverage instrument. It's a duration that matters a lot. So smaller the duration, let's do this for 5 days. Right. Smaller the duration, better could be a chance. I mean, I would say lesser is the risk that you may end up losing money even if the stock moved in a direction. So for 5 days, you may end up better than just holding a no leverage, right? So I hope this helps you to understand that these leverage instruments, I mean, you see a lot more of these instruments being talked about. More and more retail investors, once they start becoming active in market, these exotic instruments will start to show up in a lot more in the charter. But be careful if you're dealing with these instruments. You shouldn't be inventory these instruments. Right? Understand how the structure of these instruments works. Which is, if it is on a daily basis, most of these instruments are adjusted on daily basis. And that means you shouldn't hold it more than a day or 2 days. That's the purpose of these instruments. All right. Hopefully that helps you in case you are looking to, and that's the reason why I don't do SQQQ or TQQQ, because I don't know where the market's going to go tomorrow. I may have a thought that probably markets should, let's say QQQ should head lower over the next month or 2 months. Again, that's just my guess. But what's going to happen tomorrow, I have no idea. And I don't think anyone has any idea. So that's why I don't use these leverage instruments. There are other ways, to maybe take little leverage, but not these leveraged ETFs or leveraged funds, I would say. Sorry to disappoint you if you're a big fan, or if you wanted to take and go big using these instruments. All right. Okay, this is something which we talked about a little bit earlier, is around power of selling option premiums. And I just want to go back and kind of reinforce the fact that buy and hold is great, but you can make it better by buy, hold, and reducing your cost basis, right? By selling option premium. So there's an example of Disney. So Disney is now back to $87. 2 years ago, it was what, $180. Now, I hold Disney in my portfolio. I started my position in May 2020 and then bought it at $104, bought it at $145, and lowest point was $87. Right? So my cost basis of the stock is 102. Ouch, because now it's at 87. But I'll still be able to hold it because over the last 3 years, I've sold enough premium to bring my current cost basis, if I include the option premium, to 83. That's why I think it's important to learn these options is to reduce the risk in your portfolio, not to take gambling bets. And I'm still fine holding Disney, okay, because it's gone down, it's back to where it was 5 years ago, but still, for me, it is still a profitable position. And if Disney doesn't continue to perform, so from a business side, I think I don't have much of a concern right now. We'll see how Disney does in the next quarter and maybe next 3-4 quarters. And meantime, rinse and repeat. Reduce your cost basis so that you don't have to always depend on stock to perform for you. You can generate your, this is where the whole concept of generating regular income using options come in. I almost every monthly, I'll have a option position on the stocks that I'm holding to just reduce the cost basis. Sometimes some of the stocks would get called away. That's fine. You saw the list of Palantir got called away at 16. I'm perfectly fine with it. Pinterest got called away at 27. Fine with that as well. Pinterest, I think at my stock cost basis is around what, 36, but my current cost basis is maybe around 22, right? So that's one example. Another is Coupang, right? Sales of Coupang was a new share. I'm interested in it. The biggest e-commerce play in South Korea. They're doing some interesting stuff out there, just the way Amazon did it in US, but that's gonna take a long time to play out. So I'm perfectly okay to hold on to my position as long as business doesn't deteriorate. But when the stock gets crushed like this, it's difficult to hold on to these positions. It's easier to say, hey, just buy and hold. Right? But with the fact that you see so many red candles in portfolio, stock going down and down, one way it could help you to hold your stocks is if you know that that's fine, while I wait for stock to perform, I can reduce the cost of my owning the shares. So my cost basis on Coupang is $37, right? Current cost basis, by reducing the, I got $8 on an option premium in what, almost 2 years. And current cost basis is 29, right? Still underwater, but better than 37. So 37 means like what, $20 loss. Now at least you lose less, and I will continue to sell premium and reduce the cost basis. So just a reminder, right now the markets are at super high, and we never know what markets could do. I'm not saying we're gonna go down tomorrow or whatever, right? I've been selling, and we're talking about this in whatever market condition is. You may not see the impact of this in a year or 2 years, but over the period of years, you will see that it becomes way more easier to buy and hold your stock if you find a way to consistently reduce the cost basis of your stock. In one case, if the stock is paying you huge dividend, that's great. But most of the stocks that I'm interested in, the growth stocks, they don't pay dividend. So selling option premium is a way for me to generate my dividend stream and reduce my cost basis. Bobby asks, how about unleveraged inverse ETF? Are they also risky? No, unleveraged inverse ETF is fine, because then there is no daily tracking of that, right? So if your portfolio, if your broker doesn't allow you to short, you can take the unleveraged inverse ETF. The problem was not whether you are inverse or not, but whether you are leveraged or not. So if it is not leveraged, the inverse ETF will just track it 1:1, but in the opposite direction. So if S&P goes up by $1, your portfolio will go down by $1. Or if S&P goes down by $1, your portfolio will go up by $1. This is equivalent to taking a short position, but if brokerage firm doesn't allow taking short position, in that case, you could actually buy unleveraged ETFs. So that's become more of, I would say, capital allocation or capital management decision. Right? So if I, depending on, how much the money that your brokerage firm holds, for you to take either the inverse position or the short position, you can decide which one works out better. Fred says it's hard to earn Premier CPNG. Are you doing at 1 delta or what? are you doing at what DTE? So let me just pull up the recent CPNG. And again, so what's, okay, let me pull up what's my CPNG. Okay, so these are my open trades on Coupang, which I have open. Okay, on 620, I sold a covered call. And at a 20 strike price. And then on 3rd of July, opened a short put against that covered call. So now I have a triangle in this, right? So I'll be okay to own the stock if it goes below 15 and okay to have it called away if it goes above 20, right? Again, it's a portion of long holdings, right? So I'm not done it in overall, on all the holdings that I hold. So I've gone with only one contract. So I haven't gone with more than one contract. So if gosh, I didn't notice what delta was it when I did it. So it was on, but I would see it could be around 30 delta, anywhere between 20 to 30 delta. And if you could, in that time, the stock was at $17. So when I did this position, the stock was around $17. Right. So I gave myself a room for what, $3 for it to go higher before it get called away. So even if this one contract got called away, the remaining shares will benefit a lot. Right? So that was a decision on why I did this. DTE 620, that means what, around that was actually June 20, right? So that's almost 60 days. Make sense? Does that help? So far on Coupang for this year, and what, let me just see, have I been doing only one contract? I've been doing only one contract for this whole year. And so far, not including these because these are still open, on that one contract, I've collected so much, $256 of option premium. That means the cost reduced by $2.56 using just one contract. Right. Of course, if I hold 200 shares, then the cost has been reduced by $1.28. Right. But I've used only one contract so far. I didn't even, bet, or I didn't even use my whole position. If I had probably used or would have done this option selling on my overall position, maybe would have collected a lot more premium. But then, hey, if the stock goes high 50%, I don't want to be, I don't want to get called out and not participate in that growth. So I took a decision on maybe do one contract. Remember, I don't want to do anything more than what's I have kept in my coffee can portfolio, right? So I need to protect those and play with the rest of the shares that I have. And this is what, let's say July expiration, right? So the open one is August. So say 7 months, $2.50 on a $17 stock, 2.5 divided 17. That makes you 14% return or 14% reduction in your cost basis, right? So maybe even if the stock doesn't perform, I could still extract 12 to 14%, 15, 16% return in a year on Coupang. I mean, that's the power of option selling. And I can wait for stock to do its thing, because we don't know when the stock will start to perform. So I hope that helped. And that's why I keep harping on buy, sell option. So buy, reduce our cost basis, verify if your business thesis is good, just hold it, keep reducing the cost basis. Cool. I'll share a couple of examples. Again, you do it for 1 month, it will not make a big dent. You do it often, you start to see these things accumulate. Right? In 7 and what has Coupang done in these 7 months, starting in January? It's been, let's bring it up, CPNG. 2023 starts here. It's been pretty range bound, right? It's just tracking in this particular range. Let's put it this way. 2023 is right here. Okay. Damn. So it's been in this range. So lowest was 12.67, highest was close to 18. And while it's been trading in this range, you know, we've been collecting premium slowly and steadily. And over time, that premium added to $256 on a $15 stock, which is a decent enough return on, and the stock is also up 14% year to date. So there we go. Stock is up 14%. You reduced your cost basis by 14%. You already amplified your gains. That's where I would say, as a retail investor, I would want to focus on when you're dealing with options. All right. Any other thoughts on how else would you reduce your cost basis? Otherwise, we are just on mercy of market. What do you guys do? You could buy a whole and maybe then cry if stuff like AT&T happens.
Vivek.
Go ahead.
I don't do options yet. I don't think, well, I just, I told you I lost about $20,000 in the past 2 years or 3 years, but I'm just buying Chinese stock. I expect them to boom.
I mean, I have Chinese stocks on my portfolio.
So I'm looking, I already have some Xiaomi, but I think I want to buy more Xiaomi because all I've been buying is BAF.
Mm-hmm. So that's fine. I mean, you buy the stock, and then we expect it to go higher. The bigger question is, I mean, that's our hope that it will go higher. And for me, for personal reason is, I don't want to, just wait on the hope that it will go higher or when it will go higher. So I do want to look at a ways for me to reduce my risk. Basically, this is reducing the risk, right? Even if the stock doesn't perform. The other way, or if the stock goes lower, the other way to reduce risk, which people find is reducing cost basis, is to double down, right? Let's say, hey, right now my cost basis is 29. I could buy more shares of 17 and double down on it. That's one way, but that means you're adding more capital on your existing position. So I found a way which works for me is either covered calls or call spreads, or if I want to acquire a stock, hey, sell a put instead of just buying the stock right away, because then I pay less than what I would have otherwise paid. And over years, it starts to make a difference. It won't make a difference in a month or two. You may feel like it's more work than the fruit that you're enjoying, but over years, it will start to add up. I can share some other example. Let me just pull up one more. Which one shall I pick up? Hold on. Okay. Yeah, see, I have BlackBerry. Right? You remember the old BlackBerry? No one uses those phones anymore. But I got interested in BlackBerry because of their foray into the cybersecurity. When they did a Silence acquisition, then they are big into their car operating system. So I'm still a little bit bullish. I've been bullish on BlackBerry, right? But BlackBerry doesn't care whether I'm bullish or not. And the stock hasn't performed over these years. So I started my initial position looking at is in October 2019. Right? It's almost 3.5 years ago. That's when I started my position on BlackBerry. Started buying it, selling options and all that. And now my current stock cost basis is $5.50. And where is BlackBerry right now? BlackBerry is just tad below 5, I guess. 4.70. Okay. So for me, over 3 years, it's been a dead investment. I am still bullish about BlackBerry, but the thesis will take a time to play out. And that's why I still watch its quarterly results. And I haven't seen any reason to sell my stock. But now if I include my option premium into this, my cost basis is $45. So this helps me to hold my shares. Because for me, it is like already 3x gains. It's a reverse way of looking at it. Instead of your share stock price gaining, you're reducing the cost that you have paid for acquiring that stock. So for me, even if the stock takes another year, 2 year, 3 year for the thesis to play out, I'm perfectly fine holding it because, hey, I've recovered a lot of money that I put into the stock. So that's all. And it took time. Did it over 3.5 years. It takes time. It's not going to happen in a day or two. So that's a message I want to convey. I mean, if you want to do options, use it the right way. I see some comments. Naresh says, covered call a very good method, sometimes limiting your upside potential if the stock goes up very quickly. So we talked about it. Whenever we looked at the different variations of covered call, right? So for those called a meme kind of a stocks, I don't just sell covered call on all of my stock positions, right? So like PLTR, my covered call got assigned at 16, but that's not even 1/4 of my position. I covered call on my Pinterest got assigned, but that's not like half of my position. So one is you could do covered call on partial position, so that, yeah, Palantir got assigned, that's fine. I still have 3/4 of my shares that those have performed well, and I will continue to ride it out, right? I'll continue to be on the train if that continues to go high. Or the other way is, instead of doing covered call, you do covered call spread. Right? Sacrifice a little bit of a premium, go and create a $10 wide spread. Right? So that if the stock really goes to moon, maybe you didn't participate for that $500, but then for the rest, you still participated in it. So there are ways in which you can construct the trade to make sure that you don't have a seller remorse. Right? And I agree with this comment, because I think in 20, maybe in someone who would have sold covered call on NVIDIA at the start of the year might be cursing themselves, because why did I do it? I mean, I hold NVIDIA, and I've been selling call spread on NVIDIA. Like, it's a different thing. NVIDIA went high, so I closed my call spread and then sold some of those shares. Or which other example can I take? But there are stocks in which, if I am little, if I'm a little skeptical, saying, hey, these could become or could go up too quickly, too soon, then instead of selling just a covered call, I probably will sell a call spread. So these are the ways. Again, the whole thesis behind this is, guys, if you open up your portfolio and you see your stocks are down 40% and that makes you difficult to hold your stock, hey, there are ways in which you can reduce your losses, or in some cases, you can be even profitable, even if the stock hasn't performed. But you have to do it like a business, right? Not that you've done it with once and say, oh, okay, that's fine. You have to just do it. Come, do your stuff, do it again every month, slowly and steadily. This will add up. I see message for Kunal. For me, I've lost a lot in options. I try to do dollar cost averaging. If I'm still convinced in my long-term view of the company, less it's a kind of a lost cost. Yeah, so I don't know in terms of, again, depends on how we use options. And the other thing is, in some cases, I am deliberately okay to lose on options because it helps the rest of the portfolio gain. So this year, in 2023, I've lost in options in QQQ. Why? Because I had a short call position in QQQ, because I always have short call positions in QQQ, because I hold a lot of other tech stocks in my portfolio. So if I only look at the options, yeah, I lost money in QQQ. But do I care about it? No, because it made a lot more on the long side of the portfolio, right? That's a risk management. If I go back and look in 2022, I made a lot of money in QQQ short calls, right? That ended up positive for me. But the rest of the portfolio was down, so it reduced the risk. Again, I think at the end of the day, there is always a give and take, right? You cannot reduce your risk without giving some upside potential. So you have to decide of how much you want to, or if you are okay to take a swings of 40%, 60%, that's perfectly fine. Right? I do want to reduce the volatility in my portfolio. And that means instead of, you making 40%, I made 30% this year, that'll be perfectly fine. If instead of losing 30%, I only lose 20%. But that's kind of an investor I am, to reduce the volatility. And that's where, the options have. Ramesh, hope and praying does not help in the market. Option does help recover or profit. Exactly. That's the whole idea. Henry said, need BB.ai. Hopefully, let's see if in this earnings call, when's the BlackBerry's earning call is? It's way later. So next earning call, we'll see what they come up with. Fred says, I think this is why sell short put if the stock skyrockets. That way you can keep your stock. If it goes up, I think this is why Vivek sells a short put. If the stock skyrockets, that way you can keep your stock. If it goes up, by taking the premium collected from the put short. No, so no, so for the stocks that I fear that could skyrocket, and we have had such instances in 2020, 2021. For those, I do, whatever I said here, either partial position or a covered call spread. So let's go back to these cells that I had, right? This was covered call spread, partial position, covered call spread, partial position. So I still hold all the stickers in my portfolio. But I reduced a little bit of a cost basis by selling either a covered call or call spreads. Selling spread is okay, but that does not satisfy greed. We end up into problems because not that the tool is incorrect, but because we are greedy. And let me tell you the other way around also. Please do not buy the stock just because you think you can sell covered calls and get a lot of premium in that. I've seen some of my friends getting into the stock because they say, hey, and I don't even know which stock is that right now, but these are the days of 2021. Let's say you pick UPST, Upstart. And I don't know, I haven't looked at Upstart in quite some time. Right? But now you go home and say, yeah, Vivek talked us about covered call and we can reduce the cost basis of the stocks. So if I buy Upstart right now, it is $54. Right? And maybe I can sell a covered call at $65 and I can get a 10%. I can reduce my cost basis by 10%, right? So if the stock doesn't go higher than 65 at expiration, you retain this, whatever, $5.70 or $5.80, which is close to 10%. You made more than 10%. So you reduce your cost basis by 10%. And then you think, oh, I do this 5-10 times. My cost of owning shares have gone down by half. That's a wrong way to look at it. Because you should only do this if you are interested in to hold the Upstart as a company, if you like Upstart's business. Because what could happen is you bought this as 52, you sold this covered call, stock goes down to 20. Now you're stuck with this $20 stock. And if you had no bullish opinion about the stock, then you're kind of in a tough position, right? So first thing is in this covered call position, most of your risk is on the long stock position. So make sure if you are buying the stock, you like the stock, you want to hold the stock. This all the other strategy around options is how can I hold the stock for a long term? Right? Stock is not performing. How can I continue to hold it? Disney is back where it was 5 years ago. If I bought Disney at $80 or whatever, $90 5 years ago, and I haven't done it sold or done any options selling to reduce my cost basis, then I didn't make anything. But if you had sold premium on Disney over last 5 years, you could have easily gotten $20, $30 out from Disney. So in that case, stock still staying at 90 doesn't hurt that much. It's not a good position to be in, but it hurts a little less. That's the message, I would say. All right, enough about option selling. That reminds me that the world is so small. I was talking to one of my friends around options and was sharing some of my thoughts. And he told, he wasn't big into options, but he told he has a friend who is big into options, and maybe he can connect me to his friend. And that friend, Mr. John Doe, he runs, maybe million or couple $1 million of his accounts on trading options. So then he told John Doe, I'm like, John Doe, is that the John Doe who is in Apple? He said, yeah, he was in Apple. I'm like, is that the John Doe who went to Wharton? Said, yeah, he's the John Doe. I'm like, he has a less hair. He says, yeah, he's almost bald, but how do you know him? I'm like, the world is so small. So actually, he spoke to me 4 years, I think, 4 years ago, because he was just getting a start into options. So I'm happy to hear that he's still active in options. But then I realized that how small the world can be. And especially the world of retail investors who are interested in options is even smaller. Okay. Next, I think let's talk about going to the East. US is already done great this year. Its QQQ is up 42%, SPY is up 18%. Now I want to talk about a thesis for investment in Japan. Again, was that an article I read or maybe somewhere I heard? So I spent some time collecting those thoughts and collating that information to come and share with you. And again, this is not my original research. I mean, most of the time, it's I'll pick the stuff from what I have read and come and share. And there's so much of free information available. You just need to know where to pick it up from, right? So far, Japanese market, which is Nikkei 225, is up almost 26%. It's done even better than S&P. So that's a great year for Nikkei, and you would think, why do you want to go to Japan when it's already up 26%? But looking at historical performance, they haven't done over the last 30 years, they did nothing. And imagine if you were not selling options for the last 30 years and just bought and held Nikkei 225, you got a 0% returns, right? So these were lost multiple decades. You never made any money. So people thought that Japan was a sucker's trade. You always get drawn into Japan by some story, but never make any money. So then I went ahead and picked up this on a Yahoo Finance on this chart. It's actually true, right? 99. So this is what in 2023, and it just hit where it was somewhere in 1990. So now it has recovered over the last big 30 years. But what happened over these last 30 years? The valuation kept getting cheaper, right? The second, that the growth was mediocre. And again, Japanese companies are not known for the same style of management that US companies are. It's not like truly capitalist society. They are not known to be as shareholder friendly as US companies are. Third, there was a misallocation of cash, right? Japanese company don't buy back or issue the dividend to the same extent as the other developed markets do. Right? Instead, they'll tend to hoard the cash, or they'll invest it in, but the investment in bad investments. So all these factors produce a cocktail of badness. So among all these factors, then why the best investor in the world is bullish on Japan? If Japanese market has been so bad that they haven't performed anything over last 30 years, they are known to misallocate the cash. The growth hasn't been anything. So why Warren Buffett start to own Japanese stocks? So on June 8, 2023, so Berkshire Hathaway, they added additional shares in top 5 Japanese trading houses. So I think, if I recall correctly, Warren Buffett started to build their positions, I think somewhere late last year. Someone can fact check me on this one, but they recently added to their Japanese position. And the 5 companies that in which Berkshire Hathaway has been adding, its stake is Mitsubishi, Mitsui, Itochu, Marubeni, and Sumitomo. And now their intention, so Berkshire's intention is to continue add, more shares of these companies, up to 9.9% of each of these companies, right? They don't want to go. I think if you go above 10%, there is some other regulatory stuff or stuff. So they want to, Berkshire Hathaway wants to cap it at 9.9%. So what caused Buffett to go into such a dull, unattractive, terrible, market that hasn't performed? Again, I think Warren Buffett is known to go when others are fearful and be fearful when others are greedy. So number one reason is because no one wants to put money in Japan, the valuations have become very cheap as compared to the valuations in other parts of the world, right? So you are buying things for third of a cost that you'll pay for equivalent companies in USA, right? But how about, okay, I get it, valuations are cheap, but maybe cheap for a reason, right? How about the whole concerns around their growth and their cash misallocation? So now let's talk about capital allocation. So Japanese dividend yield has never been the same as with the United States until last year. So the winds are now changing in Japan. The dividend yield of Japanese stocks start to rise above that of US stock, and that's the first time that has ever happened in the history. So probably that's a big thing. So we are starting to see a better payout ratios. Payout ratio means of the overall free cash that the companies have available, how much are they paying out in dividends? Now the Japanese companies have to have started to pay out more in dividends. So things are changing. Number two is a recent article I saw, which came on February 22nd, is Japanese, and these things happen only in Japan, right? So interesting. Japanese exchange sent a notice to the companies saying, guys, you figure it out. Your market value, your company is actually trading at below your book value. You don't see that thing happening often, right? A company trading below book value is the holy grail for value investors. Generally, in the US, we don't generally see that happening. Very few companies. But in Japan, it is pretty common, looks like. Now, first sounds crazy. I mean, that the exchange asked the companies whose stocks were trading below their book value, they say, guys, fix up your capital allocation. You know, things in the US, we might think that NASDAQ coming and telling all these unprofitable companies, hey, go and fix your revenue. But in Japan, I think exchanges can. So they did. Of course, this is not a fiat. This is not an order. It's kind of a request, but which if it's coming from Japanese exchange, companies do listen to that. So some of the example, like, so after that, companies started to change in terms of how they allocate capital, and some of the companies like Citizen was up 35%, Honda is up 10% and all that. Now, how do you address the fact that your market cap is below the book value? One way is to reduce your book value. So that's what many of these companies started to do, is to reduce my book value so that then the market cap will anyway become higher than the book value. And if you understand, the book value is nothing but your assets minus liabilities. So one easiest way to fix up this issue is to use the cash that is sitting on your asset and just buy back the shares. Because if you buy back your shares, you have reduced your assets, so your book value has been reduced. Now your company's market cap is suddenly higher than book value. And then these Japanese companies didn't have to do anything for it. They won't have to sell more. They just have to use the cash that's been lying on their balance sheet already, but just allocate it wisely. So that's one area where we start to see a lot of companies are now, this could be the tailwind for Japanese market. Because in Japan, half of the Tokyo Stock Exchange Prime Market Index members trade below book value, compared with just 3% of S&P 500. See the stark difference? Even the blue chips in Japan, right? 1/3 of Topic's 100 stocks, like these are the bluest of the blue chip. They have a price to book ratio which is worse than what we have in US. So one easy way for these companies to address this is to, that's the easiest one, is to just use the cash that lying on your balance sheet and then pay it in form of dividends, or you buy back the shares. So that's what the company that could become a tailwind behind these Japanese companies. Okay, so that addresses the cash allocation. Not talking about the growth concerns. So Japan had closed its borders after COVID, right? Until October of 2022. So they've shut down their borders. And now tourism account for 8% of Japanese GDP. That's a big part of overall economy. Now, if you think that the Japanese travel and tourism went down 50% when the border was closed, which probably is reasonable, and you think that it can go back to 2019 level when they reopen their border now, we are still looking at massive increase in Japanese GDP just from reopening the borders. So even if, overall from economy perspective, that will still give them a boost of almost 4% increase in GDP. Add to it the way of addressing the capital allocation issue. Now I think, why Warren Buffett start buying these Japanese stock last year. And this year, he already added more to its position with the thought that he want to add more to it later on. So to me, this was, again, I have never looked into Japanese market, but now that got me interested in, gosh, if it came back after such a long, wait, and now those who are technical chartists probably can explain if this becomes a new support level, if this breaks out of it, could we see a bull run in Japanese market after a long, long time? Warren Buffett thinks that in near future, a near future could be year, 2 year, 3 year, Japanese market probably will be one of our better performing markets in the developed world. And that's why Berkshire Hathaway is building its positions in the Japanese market. I don't have 170 billion sitting on my side. So how do I invest in Japanese companies? So there are ways. One is to take positions in the ADRs if you're interested in taking positions in individual stocks, right? Or number two, if you have an account in Interactive Broker or any other broker that allows you to trade into directly into the Japanese exchange. So here are a couple of links. I will put that in the chat. Is a list of ADRs, right? So I didn't know, but Japan has a lot of ADRs over here. Complete list of Japanese ADRs. Oh, these are on exchanges and these are on OTC market, right? So if you are interested in individual companies, these are the ADRs. Or the other way is maybe just get the ETFs, because again, if you are not analyze an individual company, I would rather not put it in individual company, right? If I don't know about a company, if I have not looked at the company, then I don't want to put money in individual company, but maybe go with an ETF route while I bring myself up to speed on a particular company. So now when you look at ETFs, there are a few ETFs. I just want to throw out some names in case you were interested. One is Franklin FTSE Japan ETF, ticker FLJP. Pretty low expense ratio, 9 basis points. Dividend is 2.07 dividend yield. $1.3 billion asset under management. So what it holds? It holds more than 500 large and mid-sized Japanese equities, kind of a S&P 500, I guess. So that's one, FLJP. The other one is Nikkei 400 ETF, JPXN. This expense ratio is pretty high and very, I would say, thin, very low asset under management. But this has, specific thing is that it holds the companies that have perceived shareholder-friendly activities. And no individual name hold more than 2% of assets. But only 80 million, 0.48 expense ratio, that's big. Third one is, this is the most liquid Japanese ETF, is EWJ. Expense ratio is high. That's one of the highest expense ratio. But this is the largest fund when it compares to asset under management. So which is EWJ. What it holds, this is the oldest Japan ETF, largest by asset under management. It is most liquid and it holds portfolio about 240 large cap Japanese equities and tracks the benchmark MSCI Japan index. So my preferred route would be for FLJP. I didn't check FLJP. Volume is fine. I would have liked to go with FLJP because its expense ratio is pretty low. It's only 9 basis points. But what I don't like here is hardly any option interest, open interest or volume. So again, my strategy would be not to just buy and hold, but buy, hold, or I'll probably add one more step here. Short put, buy, covered call, hold, then strangle. Right. So then I need something which is more active on the option side. So FLJP, nope. EWJ, 7 million shares, a lot of much better volume and open interest. Even though the expense ratio is highest, it's 50 basis points. I think, and again, it's just me, don't take it as that you should do this, but I would rather go with this because this gives me an option to reduce. This will give me an option to reduce the cost basis of my stock or ETF, right? Because I don't know, maybe like it generally happens, if you buy the stock, that will fall down. And then if you sell the stock, that will go up after you have sold, right? So that's pretty standard. Could happen, has happened many times. So I do want to figure out a way in which I can continuously reduce my cost basis so that it becomes easier to hold over a long term. But I think I have no positions in EWJ. I have no positions in any so-called Japanese company. So maybe this is a ticker that I may think to add in my portfolio. You can decide based on what your portfolio is, and do you think it really makes sense to go to Japan in near future? Warren Buffett did. Now I understand why he probably went to Japan. Right? Even though, I mean, he'll always say US is the best, but why he started building up these positions in Japan. Now it makes sense. So, so I'll maybe sometimes you could. I don't think I'll start with the position which becomes a top 10, So you may not see in my portfolio until it becomes top 10, which I don't know if it ever would. But I think I probably will. I am interested in looking at Japan. I see Naresh says exchange rate risk. I think that's the risk is there in any company that you invest, which is outside of US. But I mean, I have many companies which I hold, which are non-US based companies. Let's say one of a top 10 position, ASML. Yeah, always have exchange rate risk. Over the last, I would say, a year or two, we see a lot more risk impact in last 2 years. But I think if a management is good, they'll figure out a way to hedge it, right? So I'm not too worried about exchange rate risk. And Japanese bank, the Bank of Japan anyway is notorious for doing yield control. Whereas India, IND and INDY, Indian ETFs are good for options trade too. Yeah, if you're going Southeast Asia, going to India, yes, and I do have a positions and I do trade INDA. I've not looked at INDY. How is it different from INDA? No. INDY, no, from option side, they are not good. Maybe that's the reason. I mean, the options are so wide. This is not for me, and I think probably I could have looked at it earlier, but that's why I am in INDA when it comes to India specific ETF. So I do have position on INDA. The INDY doesn't suit me. The options are not liquid enough. So that's around on going to Japan. Go east. Let's go east. But I think it's important to pick which east. Chinese stocks, not done good right now. I think there's a concern around a recession setting in. I mean, they reported their growth numbers were lower. But we'll see. Okay, last section. Oh, we are already hit our time limit. So do you want to go, or maybe we'll do next week? Or is there anything else that you want to talk about? I don't think I have anything else other than earnings. So yeah, if you can hang around, we can quickly go through earnings. So I have a Tesla, Netflix, TSM, ASML, 4 earnings. So Tesla, let's look at that. 9.6% operating margin. I think that's where the stock got killed. Not killed, let me put it another way. Stock market didn't like it. Overall, let's come here. Revenues of $21 billion, up 46%. That's the automotive revenue. Energy generation and storage was up 75%. So that's a area of, this is a growing area. And gross margin was down almost 6.82%. So if you really look at gross margin was 18% as compared to the previous quarter where it was 25%, and their operating margin is down to 9.6% from here of 14.6% previous quarter. They have a free cash flow of almost $1 billion free cash flow, which is nice. What else got my? I think the Tesla, the only issue around the Tesla was 2 things. One is, number one, they have committed 50% growth year over year. So right now, this quarter we grew 46%. Yeah, not too bad. They had reduced the price of Model Y and maybe some other model, I don't recall, but definitely Model Y, they reduced multiple times. They've reduced the prices. of their cars. I don't know what Musk want to do. Does he want to maybe drive out all other automotive companies out of business and see how long can, let's say, Ford and GM can hold off? And after Tesla announced a price reduction, Ford also announced price reduction in F-150 Lightning Net, the truck. So there's a price war going between EV companies, and because of that price war, we see that the gross margin has come down, the operating margin has come down. Operating margin has been coming down for now like last 4 quarters. Sequentially it's been coming down and down. So market is really a little concerned about it. If Tesla is a premium product, if customers do want Tesla's cars, and I think Musk has mentioned that Model Y is the best-selling car or best-selling vehicle in the world. And if that's the case, then why this pressure on margin? I don't know what the reality is, but Street didn't like it. And the stock was down, what, 10%? The stock was down almost 10% after earnings. And then I think on Friday is down a little bit more. But still had a decent run, 140% up for the year. Not bad at all. But the question is, going forward, looking ahead, will the margins continue to be challenged? If that's the case, then the whole story around there is an infinite demand for the cars, for Tesla vehicles, isn't really true. Okay. So anyway, so that's a quick glance at Tesla. The service and the storage, that stuff, I think is a silver lining. If that continues to grow, right now it's a very small portion of the overall revenue, but if that continues to grow if they can increase the overall contribution from that sector to the overall revenue, that'll be great. Again, then Musk, I think this came in, I was also listening into the earnings call, and Musk, and I picked up something interesting from Twitter. So Tesla earnings call was wild, gave investing advice. He cited Benjamin Graham and claimed Tesla could be 10x from here. Right? So he says, autonomy will make all these numbers look silly. I recommend looking at ARK Invest. So Kathy's fan of Tesla. He's fan of Kathy. Says their analysis is very good. What else he said? The outrageous, 10x or 9 trillion mark, plus a reminder to buy and hold. He says, I care a lot about that sort of a small shareholders, especially the one that have stuck with us through thick and thin. I love you guys. Like, I have a very high confidence in the long-term value of Tesla. I really see the path to 10x, maybe 5x, maybe 10x. So just buy and hold. Then he recommends buying stock in companies who make products you love, which is what we should do. I agree. Tesla Model Y became the best-selling vehicle of any kind globally in Q1. And says it's ridiculous that Tesla has a free cash flow, and because it's a capital-intensive business. And claims that Tesla Robotaxi will drive volume through the ceiling next level. But I've been waiting for Robotaxi for now 3 years. I don't know when it will come. A lot of promises have happened on Robotaxi. I've yet to see one out. Again, the full FSD of Tesla is not where it should be for Robotaxis to become a reality. So I think still a long way to go, but Elon is Elon, right? Who can question Elon? Says in long-term autonomy, we think it's going to just drive the volume through the ceiling, next level, ceiling of next level, not your own level, right? And our sort of future Robotaxi products, dedicated Robotaxi products, we think will have a quasi-infinite demand. We don't see many CEOs talking about infinite demand. Now, full self-driving will be 10 times safer than average human driver. I agree. Other milestone is Tesla has collected over 300 million miles of worth of data to train their model. What else? And then he starts to talk about Neuralink and building robot arms and legs. And then the supercharging network has now surpassed 50,000. And I think this is really a good news, because looks like even now Mercedes and Volkswagen, they've also joined Tesla and have decided that they're going to use the Tesla's the standard for power. One other thing which was there, which probably is not in this tweet, was around Tesla's Dojo. So Dojo is Tesla is building its own big AI system called Dojo, and what he mentioned was maybe it's going to be 5th biggest supercomputer in the world, something like that. Someone can correct me, but if I think that's what I recall. So that's on Tesla. So what, buy, hold, what do you do? I don't have any Tesla positions, but I might, again, I've been trying to look at Tesla for a long time. Still, for me, it is, where it lies in terms of, maybe we should, Tesla. $55 PE, 76 PE, 55. It's in a growth mode, so PE may not be the best way, but still 10 time price to sales. I'll wait. Maybe let it fall down a bit if it ever, or maybe I'll do a put spread. To me, it still looks a little expensive. I sell covered calls at 10 delta and short put 40 days out. Yeah, I don't have any shares, and I don't want to go and sell a naked call on Tesla. The Tesla army, the Tesla crowd, they can come back after any time. And that's where then that one trade could just bite in your back and you'll end up losing tons of money. I don't have to do that. Cool. So next is Taiwan Semiconductor. Overall, big picture, both from Taiwan and ASML was, the semiconductor market is slowing down. Right? They had a decline in revenue. Customers are postponing their purchases. So even though it was better than consensus, but still it was down 13.7% year over year. Gross margin was 54%, operating margin 42%, which is great. But again, the margin were contracted because of lower capacity utilization. Now imagine TSM is having a lower capacity utilization problem. So that should tell us something about maybe Apple, because Apple, one of a big customer of TSM is Apple. Also NVIDIA. So if TSM is having lower capacity utilization, that means they're making fewer chips. That means the customers are not asking for those chips, means customer probably will be selling lower than what they were expecting to sell earlier. They have $49.7 billion on cash, in cash, which is fine. So our second quarter business was impacted by overall global economic conditions, which dampened the end market demand and led to customers' ongoing inventory adjustment. Right? Easy way to say is our customer didn't buy as much as what they thought they would. So that's why the revenue was down as compared to last quarter. The Apple and NVIDIA projected a 10% fall in sales in financial year 23. So that's where we go. That's what Bloomberg reported. For the next quarter, they're looking at maybe 10% higher revenue than what they did this quarter. But again, also, they postponed the production facility in Arizona from until 2025. So TSMC, so they are building a fab in Arizona. Now they're saying they're postponing it until 2025. I saw another, I think, did I have it here? Yeah, so we'll talk about that. Nothing much, not big of a difference as compared to previous quarter. So good thing is the high-end chips, which is 7 nanometer below, now constitute more than half of their revenue. So 7 nanometer is 23%, 5 nanometer is 30%. So 53% of their overall revenue is coming from high-end chips, right? Where TSM has very strong position. Revenue by platform, smartphone is 33%, high performance computing is 44%. TSMC also said that the premium of producing the chip in US is about 50%. So which is huge gap. So what TSMC is saying is making a chip in US gonna be 50% costlier than what they're making in their other plants. Could that be a reason why they have moved their Arizona plant opening until 2025? Maybe. I don't know. So it looks like maybe there's some negotiation could be going on with White House for some more concessions because it's going to be expensive. These chips are going to be expensive. ASML. Coming to the next semiconductor, ASML net sales almost 7 billion with an income of 2 billion, which is higher end of their guidance. Bookings were little down. Q3 is around their guidance, and the overall for the year, they increased the guidance. I saw similar vibe from ASML. Again, they're saying this quarter, I mean, the previous quarter wasn't that great, but I think in the later part of the year, they expect the demand to pick back up. ASML also does dividend, is a dividend paying company as well as it does a share buyback. So I'm a happy shareholder of ASML. As I said earlier, I added a little bit to my position when the stock was down, 7%, 10% after earnings. So I added a little bit on my position. So commentary is our customers across different market segments are more cautious due to macroeconomic uncertainties and therefore expect a later recovery in their markets. So, and I know TSMC told that maybe the market will recover in Q3. Now they also push that out to Q4. So semiconductor people, you tell us. I see comment from Ramesh. Oh, okay. So I got confused on the Ramesh's comment saying that covered call at 10 delta and short put 780. So that's for that was for ASML. Got it. So right now, I think I have a iron condor on ASML. I work in semiconductor industry. Company froze all travel and non-essential expenses due to softening of the market. Yeah, and it showed up in their results. What's my strike? Hold on, let me just pull up. What's my ASML trade? Just this one. So my strikes are 640, 610 on the put side, put spread, and 750, 780 on the call side. So, and this is August. Now let's come to Netflix. I think that's the last one. I don't own any Netflix, so haven't been tracking really closely, but Netflix is again one of those, bellwether company that tells how maybe the other streaming companies will do. So overall, Netflix, what did they do? Launched paid sharing in 100+ countries. Let's look at the numbers first. The revenue grew only 2.7%. I thought they had enough subscribers. Subscriber global streaming paid membership grew 8%. Wow, almost 6 million new subscribers. That's great. So your subscribers grew 8%, but your revenue grew only meager 2.7%, less than 3%. Means most of the subscribers have come from low ARPU, or I don't know what they call ARM, low ARM countries. So maybe a lot more focus on in Asia or other countries where you do not get the same pricing power as what you have in North America. That's why, despite growing 8% subscriber growth, you only had 2.7% as your revenue growth. So 8.2 revenue of 8.2 billion, operating profit of 1.8 billion, generally in line with their forecast, still targeting operating margin 18 to 20%. What else? We had a paid net addition of 5.9 million, which is what we saw. What I also saw was, I think Netflix is deciding to do away with the lowest paid subscription tier. I don't know. I think I'm paying $15 that plan, but they want to do away with the lowest paid subscription plan and push customers to either the higher paid non-ad subscription plan or to lower cost paid ad subscription plan. So it looks like that those ad subscription plans, they make more money on the ad subscription plans than on the non-ad subscription plan. So which is strange. So if I don't want to see, so Netflix would rather push me towards an ad-based plan, because that's where they make a lot more money, including the money that they collect from me and they get from advertiser, than what they would make by charging me whatever $16 on an ad-free plan. So it is strange. So that's on Netflix. I think again Netflix stock was also didn't perform well. I don't hold this, so I don't know what the number would be. It fell down, what, 8%, 8.5% after earnings. And I think the concerns are around, number one, same as Tesla, number one, on margin. Number two is around this whole strike which is going on. So those are the two reasons.
Vivek.
So that's on Netflix. Yeah, go ahead.
I'm very happy with Pluto TV. It's free, and I can't really relate to the TV series in the last 2 decades. I mean, I watched Mad Men and I don't know, the other and other series, but you can't really relate to it. How can you relate to it? Do you watch Indian shows on Netflix?
No, I don't watch much of a Netflix. Netflix, most of my kids, because the only thing is I don't spend too much time watching on Netflix. I would rather go and read a book or do this analysis. but my watching time is either when I'm cooking or maybe when I'm eating, and that means I need to find something which is 30 to 40 minutes. And my staple has been watching FBI Files on Amazon Prime because that is 40 minutes episode. In Netflix, I don't know. The whole last week, I don't think I watched anything on Netflix in this whole week or even in the previous week. So yeah, I'm not a much big Netflix stuff. Maybe if we're doing a family movie, then I'll sit and watch. Or if there is a movie, I'll watch. But this otherwise, I only have to find something which I can finish in 40 minutes. So mostly it's a documentary is what I could end up watching. Or if it's a long weekend or a holidays is when I would rather spend watching time on any movie, etc. But right now my staple is FBI Files. 40 minutes and you're done. Watching a series is that then you end up doing a binge watching, which is what I don't want to do. Or if there is another series which is like episode by episode and it starts and finishes in an episode, I would rather do that. So yeah, I'm not a big Netflix guy. But you know, someone in your household will be watching Netflix, so I have to have that subscription.
Oh, do you have an library card? Library card, you get like Canopy, and I also get San Francisco what the library system has. And since I'm in San Mateo, you know, they have DVDs in the library.
Oh yeah, I mean, we used
really
to
want to be cheap.
No, I used to bring DVDs earlier, but no, I think my kids, they need Netflix more than me. It's the kids. So that, and this is what happens. You end up paying for every streaming. So what we got Netflix, we have Disney Plus. Of course, you can't live without Amazon Prime. And I also had Peacock earlier, which then I unsubscribed to it. So we got Peacock because I think the Olympics, they were streaming on Peacock, and my kids, they wanted to watch Olympics. And then Peacock streaming was about $5 per month. So I kept it. I watched during the vacations or a holiday, I watched the whole Godfather series again. And I think a few months ago, I said, okay, I'm not watching it anyway. I haven't opened Peacock for months now. So I just unsubscribed.
So do you think Disney, I mean, I only hear the stuff that CNBC has to say about Disney. And they're actually kind of, I mean, other than Kramer likes Disney, but I don't think anybody else at CNBC likes Disney.
Oh yeah, they don't like Disney stock, but if you have a kid at home, you cannot have.
No, but what about the parks? I mean, the parks, you know, now Iger says they charge too much,
and people will pay. So I mean, parks. So again, I think right now over the last now Iger has come back, probably going to fix it, but Disney is looking. The problem with the Disney stock, as what market is saying, is some of the assets which they have to just dump it, like ESPN and all that. Some of those assets are not doing good, and they have to start park and the streaming. I think will continue to be two good standalone businesses. They have to figure out what to do with ESPN and you know, some of the other properties that they had in Asia, like Hotstars and all that, which they rolled into Disney Plus. Now they're selling it off. So, but I'm still okay with holding Disney as a stock because of the IP
recession.
That
I mean, what about the recession? Is hanging over. Now CNBC folks are delaying it for another, I don't know, next year.
Yeah, so recession, Janet Yellen also said, right, that she doesn't think that US will get into recession. I saw maybe Goldman Sachs, they have reduced the probability of US entering into recession, but we don't know. I mean, all these are the estimates that come out or the guesstimates. And
because the inverted curve happened about a year ago, I think.
Sorry, say that again.
inverted curve.
Oh, inverted, yes.
There you
So
go.
yield curve has been inverted for quite some time now. Oh, where's my yield curve? So yield curve started inverting almost a year ago, right? Yeah, July. And generally, it's what, 12 to 18 months is when you start to see recessions set in. So right now, I think the predictions were that the Q4 is when we would see recession set in. But given the job market so strong, now economists are saying, oh, probably we may not have recession, or it will be a very soft recession, right? But who knows? Economists are notorious for, not having their forecasts come out true. Fed had for 400 PhDs in economy, and still they couldn't forecast about anything around inflation or what might happen. So we'll see. All right, guys, that's it for today.
Oh, excuse me. One last thing.
Sure.
And what do you think of? Okay, last week China accused UK of inflating their currency by giving out handouts, but US has been doing that for the past 3 years. I mean, I'm not happy with the inflation. I mean, it wasn't my fault. I didn't get anything from it. Everything is more expensive. So well, you're a savvy investor. You earn money all the time. But what do you feel about this? These handouts. I mean, China didn't get handouts. Hong Kong got handouts. Singapore actually got the same handouts as the U.S., but they did not have the inflation of the U.S., which is about 50% in reality, 2020 to December 22. So what do you think of that stuff? Did India get handouts?
Nope. No handouts in India. I mean, it doesn't really matter what I think, but the fact is,
I hold your opinion.
so I don't
Yoda.
like, so I don't like giving these handouts, right? It's to everyone, and I know some of my folks that I know, they got handouts, even though I don't think they necessarily need handouts, but we just looks like they figured out whatever the criteria was and gave handouts to many people. I didn't get any, but I don't need any, and I don't think this is a way to run a company. We should help people who really need it rather than giving these indiscriminate handouts to everyone, which now the people, the inflation hurts the poorest people the most. Inflation is not going to hurt. It might pinch a little bit for people like say me, who have, thankfully, who are a little better in terms of those who are at a minimum wage. It doesn't hurt anyone who is in the upper strata. They don't even care about it. The sale of luxury goods have been, over the last year, have been great. So all the handouts that you gave in the name of trying to protect poor people, those poor people are the ones who are suffering now because of inflation. Inflation hurts the poorest the most. It doesn't hurt the others as much as it hurt the poorest. So whole strategy of trying to help poor people really didn't work out.
And then San Francisco is thinking of not charging for the parklets. That really gets me angry. What is this? I mean, it is such a, that lady is the highest paid mayor in the country of 42 square miles.
So if you talk about, I think, coming to the local side, there's a lot of stuff in San Francisco that I don't like. The city has now become, I don't
slum.
It's I don't want to use that word, but I think you
slum. I was there today.
Yeah. So
when I got off the BART, 7th Street and Market, it was junk. It was disgusting.
It's not, doesn't feel safe to be in city.
I don't see IKEA at 6th and Market. IKEA was a building there, but now it's,
a lot of tenants are pulling out. Some big tenants already pulled out. Yeah, the law and order.
So IKEA was kind of pissed off that Nordstrom left and Whole Foods, and they said, "What about us?" And I think they just got pissed off because, you know, I think they just pulled out because the building, the sign is gone. They're not doing anything any longer. They're leasing it out again.
All right. Yeah, yes, San Francisco is not good. It's not what it used to be 10 years ago when we loved visiting that place. Anyway, so I think that's all for today. And we're gonna talk again next week. Stay safe and have a good week in the markets. Doesn't really matter. It's just a week. So we'll talk to you again next week. Bye, everyone.